All right, we have more changes unfolding in the U.S. economy and the U.S. housing market. Changes that saw one of the largest bubbles in the equity markets begin to pop as a rash of selling from big money funds just started jumping ship on home builders like we warned about a few weeks ago and in a video last week as well. Well, it just started, and we're going to explain why and what it means because it's a strong tell for what's about to happen to the final pillar that's been holding up this housing market, this house of cards. We also have brand new data just out that's bad. If you thought that the housing market couldn't get much worse, well, wait until you see this, folks. Absolutely mind-bending numbers, record-breaking actually. But before we get started, if you're not already a subscriber of this channel, consider subscribing. It helps the channel out, and I appreciate your support. So home builders, folks, the supposed saving grace to this stubbornly slow housing market for the last year, we've been hearing that, so much so that major investment banks, even like Goldman Sachs, have been urging their clients to jump on the home builder bandwagon. And for good reason, you'd think, right? With residential real estate stuck in this constant malaise, home builders not buying, home sellers not selling, all due to this new high rate environment. Like a game of chicken almost, right? Who's going to break first? Well, we're still waiting on that answer. But in the meantime, from the sidelines, home builders have been raking in the dough, taking advantage of this unique once-in-a-generation opportunity, positioning themselves to benefit handsomely. And oh, have they done so? 2 weeks ago, we made a video, then again, we highlighted our point from that video last week as well, showing just how much of a bubble home builders are finding themselves. In fact, the two best performing sectors this year, big tech obviously, which we're all familiar with, in a magnificent bubble, hence the Magnificent Seven, right? But right along with them are home builders. We said in that video that anyone who's short home builders, which I know that some of you are or were, at least from past comments that you've left over the months. I know last year from your comments, a big real estate YouTuber was apparently recommending shorting home builders. Well, last year was most definitely not the time to do that. But if you did and you're still in that position, your luck may be turning around. This is what we showed 2 weeks ago. At the time, mortgage rates had just broken through their highs from last year, hitting over 7.4%. And we pointed out how the higher rates go, the worse it gets for home builders. Then again, last week we showed Hartnett's chart of the XYB and showed you what he had said, right? Writing double top in home builders is a clear recession signal. Well, fast forward to this week, we have a massive sell-off, folks. Big money exiting stage left. This is the XHB, the U.S. Home Builders Index, falling over 4% in a single day. And following this, there's now reports of Goldman Sachs clients beginning to freak out as they've been doubling down on their long predictions for months. Well, that's a problem when the 30-year fix continues climbing and the majority of your sales, home builder sales, are coming from rate buy downs. These builders are only working with these tiny margins. Their strategy was based on a temporary high rate environment, believing that they could sacrifice some of their margin with these buy downs for a couple quarters, maybe long enough until the Fed starts cutting rates, all in an attempt to just keep their annual sales numbers strong. Well, the higher rates go, the worse it gets for them. The harder it gets to keep that going any higher, and that strategy just completely falls apart. And like we had pointed out a few days ago with the release of the August jobs data, seeing the unemployment rate jump to 3.8% from 3.5 to 3.8, and how that's a strong tell that the Fed may be done. But that doesn't mean that they're going to cut rates right away. It just means that they probably believe that we've sufficiently entered restrictive territory, both of which, by the way, is good if you want to see a real housing market correction. Remember, the quickest way to see this unfold isn't with higher rates, but with unemployment. The former will correct home prices over time, years maybe. The latter causes a sudden and rapid correction. The Fed doesn't have time. They need this done ASAP. We're spending $2 billion a day right now on interest, on servicing the nation's debt. They want this fixed fast. All right, so we have home builders beginning to finally feel the pain of these higher rates. Well, we also have ordinary home buyers who've already been struggling, completely priced out of the market in most parts of the country. Well, believe it or not, it's gotten even worse, significantly worse. Take a look at this. Brand new report just released yesterday by Black Knight Research. There's two things in particular that I want to show you, especially if you're thinking about buying a house right now. This is the monthly principal and interest payment for new home buyers. Basically, the payment to income ratio, how affordable it is to buy a house right now. And we've shown this every month for the last year, but it keeps getting worse, folks. This is hands down the most unaffordable time in the history of the U.S. housing market to purchase a house. Here's what they write. The average principal and interest payment for borrowers purchasing a home in July using a 30-year fixed-rate mortgage was $2,300. That's the highest such payment on record, up 60% over the past 2 years, and is poised to push even higher with recent interest rate increases. Now, let me explain this right here. This is important. What this shows is the number of borrowers, the percent of existing homeowners who have mortgages above their means that are now locked into a debt that they need to spend the next 30 years paying off. We're talking about half of all mortgage holders, folks. Let me repeat that. Half, 50% of all mortgage holders are now stuck with a monthly payment that 2 years ago was considered rare and high risk. Here's what Black Knight writes. The average mortgage payment was equivalent to 36.5% of the median household income in July, up from 24% in 2021, marking the highest share ever of income needed to afford the average mortgage payment on record. For comparison, it only took 31% of the median household income back at the peak of the market in 2006 before the great financial crisis. So to the run-up of the '08 meltdown, this number went as high as 31%, meaning it took 31% of your monthly income to pay your mortgage. Well, we're now above that at 36.5%. The crazy part is this is the national average. When you drill down locally, it's much worse, folks. If we pull up Snapforce, we can see this dynamic even clearer using our renting versus buying map. The redder a county is, the more expensive it is to buy a house than to rent. The greener a county is means it's cheaper to buy than to rent. 2 years ago, this map was the complete inverse, almost entirely green and only a handful of red counties. For example, let's look at Madison, Wisconsin, Dane County. Typical rental costs $1,500 per month, but to buy your typical single-family house, it costs $3,400 per month. That's with your mortgage, property tax, and insurance. That means you have a buying versus renting deficit of almost $1,900 a month. Said another way, if you choose to buy versus rent in Madison, Wisconsin, you'll spend 122% more, or $1,900 more each month. It's crazy, folks. And if we go out west, it's even worse. Take a look at San Luis Obispo in California. Typical rental here costs $2,700 per month, but to buy your typical home, you'll spend $6,200 per month. That's with the mortgage, property tax, and insurance. That's $3,400 more you'll spend a month if you want to buy a house. It's 127% more expensive to buy than to rent in San Luis Obispo County. Look, like we've said before, there's one thing that's preventing a crash in home prices. One single thing, that's inventory. Once inventory begins to normalize, which it always does, by the way, home prices will as well. Hence why the jump in unemployment is so significant. All right, if you enjoyed this video, got something out of it, press the like button. If you didn't, that's all right too. Press the dislike button. Either way, I appreciate you watching.